Hello again, everyone. This is Gene Ahrensberg coming to you on Sunday, July 29th, 2012. We're about to take off for a short while, but before we do, we wanted to take a look at some of the charts which have our attention at the moment. But first, gold and silver turned in outside reversals this week, first trading to lower weekly lows, then reversing to highs up above the previous week's highs. Gold was up 2.6% and silver up a more subdued 1.5%. Mining shares mostly answered the precious metals higher, with the HUI up a solid 3.3%. And the GDXJ outperformed, up 5.5%, but the Canadian Venture Exchange Index just couldn't make it up back to flat, at least not yet. We can attribute the sudden rallies for precious metals and the equity markets in general on the Thursday comments of ECB President Mario Draghi. How about that? With that, the ECB president threw down the gauntlet, catching the shorts leaning too far one way. That sent the euro up about 300 basis points, and the US dollar fell from an 84 handle down to a mid 82 handle just like that. It also triggered a short covering shock wave in precious metals. Now, those were great words to move the markets, but we have to wonder if great deeds will follow them. Because on the one hand, if great deeds will follow them, it means a ton of money printing coming from the Eurozone. On the other hand, if Mr. Draghi's comments were bluster, he's going to end up with a batch of rotten egg on his face and a world-class confidence puncture for the European Central Bank. Now, we just don't believe that he would have made those comments without having vetted them. But perhaps the more important question that needs an answer is, what dark or menacing black swan has the European central banker worried enough to make such a bold statement? I guess we'll know in the fullness of time, but for now, let's take a quick look at some interesting charts of the CFTC Commitments of Traders reports that were released on Friday, July 27th for data as of Tuesday, July 24th. Looking at the legacy COT data, that's the Commitments of Traders report data for the large commercial traders, that's the combined large commercial traders, as gold edged $2.39 lower Tuesday to Tuesday, traders classed by the CFTC as commercial very strongly reduced their net short positioning by 22,574 contracts to 136,245 contracts net short. That's what we refer to as the LCNS, or Large Commercial Net Short Position. So with gold down 0.2%, not very much, the commercials reduced their net shorts by a big 14.2%. And that was ahead of ECB President Mario Draghi throwing down the gauntlet on the do whatever it takes to preserve the euro comments. Sometimes they get lucky. The commercial traders remain near their lowest amount of gold hedged since the 2008 panic. That is contrary bullish, because there is a clear correlation between very low hedging by commercial traders and the startup of new uplegs for the price of gold. The lower the LCNS, the more likely a gold sell-off is about to reverse course. Let's take a look at this data in relative terms. We can standardize the collective positioning of the commercial hedgers by comparing their positioning to the total COMEX open interest. We call that the LCNS-TO. The lower the LCNS-TO, the relative commercial net short positioning, the more likely a sell down is ending or a new upleg is beginning. The LCNS-TO at 32.4% as of July 24th is very close to the lowest commercial relative net short position in years since the 2008 panic, in fact. Note how lows for the relative commercial net short position are very often a signal of turning points for the price of gold. Note how highs for the LCNS-TO are very often, but not always, a signal that gold has run out of steam. There's a good reason for that. The traders who have to hedge gold to protect their margins are the smartest, best informed traders of gold. A much higher price of gold attracts increased hedger selling. A much lower price of gold means less incentive for hedgers to hedge. We think the legacy COT report for gold is more bullish than bearish when in or near the lower third of this chart. Now, the CFTC further breaks down traders into 5 categories in the disaggregated COT report, and we have data going back to 2006 on all of them. The hedgers are primarily represented in the producer-merchant category. Let's look at the chart for this category, which includes the largest bullion dealers and bullion banks. Since the producer merchants are always net short, their position is expressed as a negative number. As the blue line rises, their net short position is getting smaller, and vice versa. The producer merchant commercial traders, with 137,671 lots net short, are very close to their least net short position for gold since the January 2011 pullback. On February 1 of 2011, the producer merchants reported a net short position of just 120,988 contracts, with gold then having pulled back to about $1,341. Clearly, the hedgers were not motivated to heavily hedge gold after it had fallen there in profit taking. The hedgers were right to have a smaller net hedge position on gold then, because gold was staging for its historic run up to a new all-time nominal high near $1,900 7 months later. The producer merchants are very near their least net short position since February of 2011, with gold now in the $1,580 range. Is gold now staging for a retest of that nominal high today in July of 2012? Let's look at another class of commercial trader. Here we're looking at the traders the CFTC classes as swap dealers. Note that the mercenaries of the trading pit, the banks and firms that sell swaps in other markets and then hedge those OTC positions using futures, are currently net long gold futures by 1,426 contracts. Note also that the swap dealers are only rarely net long gold. With gold in the 1580s, the swap dealers are now on the long side of the futures trading ledger. And now we move to the traders the CFTC classes as managed money. They include hedge funds, commodity trading advisors, and other funds trading futures for clients. For the COT week of July 24th, with gold only off a tiny $2.38, the funds strongly reduced their net long position for gold futures by 21,547 contracts to 53,168 contracts net long. You have to wonder what they're thinking. We had gold off 0.2%, and managed money closed or offset more than 26% of their long bets on gold in summer light liquidity trading. Yet, gold not only held its $1,560 support, it actually ended up turning in an outside reversal to the upside for the full trading week, closing in the $1,620 range. Of course, the comments made by ECB President Mario Draghi had a little to do with that important technical reversal. Let's take a look. Here's the weekly subscriber chart, and one thing we want to point out is that outside reversals are not common on the weekly gold chart. They're not universal, but they are often a precursor to important changes in trend. Looking closer at a daily chart for gold, note the rising support since the May $1,526 low. Note also the breakout higher than the minor downtrend line up into the area of congestion between $1,620 and $1,640, the area in the yellow. Traders all over the world are focused on that congestion area because the higher into it gold trades, the more short covering it will likely trigger. A convincing thrust to and through about $1,642 should trigger accelerated short covering and additional buy stops from the momentum traders. Speaking of other traders, and back to the COT for gold futures, perhaps the most remarkable chart is the positioning of the traders classed as other reportables, very large traders who help make a market for gold, and they trade for their own book, not for outside clients primarily. As of July 24th, the other reportables reported a record high net long position for gold of 53,168 contracts, with gold in the 1580s. This record position beats the previous record high of 52,994 contracts made on December 7, 2010, when gold was then $1,401 and staging for its run to a new all-time nominal high the following September. Let's see if we can do a short summary. In summation, the legacy COT report for gold futures suggests that the combined commercial traders are not, repeat not, motivated to increase their hedges, with gold near $1,580 and consolidating in a giant flag or pennant formation. The largest, best funded, and presumably the best informed gold traders on the planet are not positioned as if they believe gold has a lot more downside. To the contrary, they are positioned consistent with previous lows for the yellow metal. Looking deeper into the disaggregated COT data, the pure hedgers, the producer merchants, are very close to their lowest net short position in years, and they're not motivated to take on a high net short position. And over the past week, they covered or offset a really big 20,530 contracts of their net hedges, as if in a hurry to get smaller on the net short side of gold. The mercenary swap dealers, who are normally net short gold, have gone a little net long gold instead. The big speculators, the funds, reported their lowest net long position since the 2008 panic this past COT week. But the managed money traders got that way in part by increasing their insurance short position to a high level, currently 33,154 contracts. Let's take a look at that. This is just the pure short positions for the managed money traders. High short positions for normally net long funds are, first of all, rare, and secondly, they are high octane rally fuel should gold catch a meaningful bid just ahead. And finally, with gold near $1,580, having consolidated back down from the September pinnacle of $1,923 last September, the traders classed as other reportables have built up their largest ever net long position for gold. Right or wrong, our view is that the commitments of large traders in COMEX gold futures is solidly and compellingly bullish. It is consistent with important turning lows in the recent past during this great gold bull market which began in 2002. The weekly outside reversal for gold this week may have been the tipping point to encourage a significant short covering rally just ahead, provided the news out of Europe doesn't take away the QE punch bowl prematurely. With gold consolidating that run up to $1,923 in a flag or pennant formation, when ECB President Mario Draghi said that the ECB would do whatever it takes to preserve the euro and that traders better believe it'll be enough, it sent a shockwave through the currency, paper, gold, and silver markets, which are skewed unnaturally short. Whether this is the catalyst we have been waiting for is yet to be seen for sure, but the indications at this early stage point to exactly that. This may be the catalyst we've been waiting for. And if there is the slightest hint from the Fed that more money printing is in the cards for the United States just ahead, the short covering rally that follows could be one for the record books. The bottom line for this brief look at the COT for gold futures: short this market at your peril and do not be surprised by gold strength just ahead. With the funds heavily short for insurance, look for significant dips, if any, to be very strongly bid, and look for very strong demand for physical gold to accelerate in the very near term. Well, that's it for this look at the COT. Don't forget to look at all the new chart comments in the subscriber pages. There sure is an awful lot of stuff going on for a normally sleepy late July weekend. We'll see you again next time. Bye for now.